You probably heard the news that the Securities and Exchange Commission has recently approved Bitcoin ETFs. But what exactly are these ETFs, and how do they work? A Bitcoin ETF, or Exchange Traded Fund, is a financial instrument that lets you invest in Bitcoin without actually buying and holding the cryptocurrency itself. There are two main types of Bitcoin ETFs, the Bitcoin Futures ETF and the Spot Bitcoin ETF. The Bitcoin Futures ETF has been trading since 2021, and recently, in 2024, the Spot Bitcoin ETF was approved. Let's see what a Bitcoin Futures ETF is. Bitcoin Futures ETFs do not hold actual Bitcoin, but rather invest in futures contracts tied to the price of Bitcoin. Futures contracts are an agreement to buy or sell an asset at a specific price on a future date. Bitcoin Futures ETFs track the price of these contracts. These ETFs offer an alternative way to get exposure to Bitcoin, potentially with some added leverage. Let's understand this with an example. Imagine you and your friend agreeing on a specific price of Bitcoin for next month. Let's say $50,000. You're bullish, so you agree to buy Bitcoin from your friend at $50,000, no matter what the actual price is by then. Your friend, being bearish, agrees to sell Bitcoin to you for $50,000. This is basically a futures contract between you and your friend. Now, next month, there are two scenarios. First, the Bitcoin price reaches $70,000. Now, you have bought a futures contract at $50,000, so you have the right to buy that Bitcoin at that price from your friend, no matter what the current market value of Bitcoin is. You are effectively locked in at that price. So, in this case, you purchase Bitcoin at $50,000, even if its current market price is $70,000. Here, you made a profit of $20,000. Your friend must sell Bitcoin to you for $50,000, even though it's now worth more. He will incur a loss of $20,000 on the contract. The second scenario is that the Bitcoin price falls to $30,000. If you bought a futures contract at $50,000, you have the obligation to buy Bitcoin at that price, regardless of the current market value of Bitcoin. In this case, you pay $50,000, even though the Bitcoin price is $30,000. You essentially made a loss of $20,000 on this contract. This is how a single Bitcoin futures contract works. Now, the Bitcoin ETFs are created by purchasing lots of these future contracts and bundling them into a fund. Then, the exchange offers shares of the fund to investors, which is known as the Bitcoin Futures ETF. The futures contracts in the fund are then actively managed while the ETF shares are trading. Now, let's understand what Spot Bitcoin ETF is. In the Bitcoin Futures ETF, the exchange only holds the future contract of Bitcoin. But in Spot Bitcoin ETFs, the exchange holds actual Bitcoin as its underlying asset. Then, the exchange offers shares of the Bitcoin fund to investors, which is known as the Bitcoin ETF. They aim to mirror the price movements of Bitcoin as closely as possible. This means that when the price of Bitcoin goes up, the ETF price also goes up, and vice versa. So, instead of trading Bitcoin on a cryptocurrency exchange, investors can trade these ETF shares on a traditional exchange and gain exposure. Bitcoin ETFs are a way to indirectly invest in Bitcoin without buying it directly. This is how a Spot Bitcoin ETF works. Here are some key benefits of investing in Bitcoin ETFs. Number 1. Cryptocurrencies are no-go zones for many investors. Because of Bitcoin ETFs, you can buy and sell Bitcoin ETFs on traditional stock exchanges through your regular brokerage account, making it easier for investors who aren't comfortable with cryptocurrency exchanges. Number 2. Cryptocurrency markets are not regulated. That's why many investors hesitate to enter the crypto market. The Bitcoin ETFs come under regulatory oversight, offering potentially more protection and transparency compared to directly holding Bitcoin. Number 3. You can add Bitcoin ETFs to your portfolio to diversify your holdings. With the Bitcoin ETF, you can enjoy the benefits of Bitcoin's price rise without getting exposed to the unregulated cryptocurrency markets. There are also some drawbacks to the Bitcoin ETFs. Number 1. These Bitcoin ETFs have management fees and potentially other charges, which can eat into your profits. Number 2. These Spot Bitcoin ETFs are still relatively new and might not be available everywhere. Overall, Bitcoin ETFs can be a useful tool for investors interested in gaining exposure to Bitcoin without the hassle and risks of directly buying and holding the cryptocurrency.